Well, positive earnings news helping push stocks higher today, that's for sure. But our next guest believes analyst estimates for the second quarter, well, they're still too low. Brian Belski is chief investment strategist at Oppenheimer Co. And he's also former chief U.S. sector strategist for Bank of America Merrill Lynch. Brian joins us now to offer his perspective and outlook. Brian, great to see you.
Nice to be here.
All right, so props to you for writing just yesterday that second quarter earnings were setting up for a likely positive surprise. How'd you have that kind of foresight?
Well, the mood really from investors, Lori, has been doom and gloom, especially for earnings as of late. And we looked back at our models and looked at earnings revisions, and we saw that about 3 or 4 weeks ago, we saw a decided negative turn in terms of revisions, meaning analysts are starting to bring their numbers down. You couple that with really the poor performance of the market the last few months. People are feeling a lot more bearish. You've had some negative economic news. So the resounding mood in thought with respect to earnings was negative. We actually did some of the fundamental work and said, you know what, these earnings are going to surprise again to the upside. I think we're starting to see the semblance of that already.
Indeed, with Alcoa and even CXS. But our market reporters, Dom and Adam, were explaining that especially with CSX, investors are concerned these companies still don't have pricing power.
Right. Well, they've had to drop pricing to facilitate revenue growth, and I think this will be the quarter where you're going to really see strong revenue growth. I think the key is that we've seen revenue growth for 3 straight quarters. I think this will be the 4th quarter in a row that we're starting to see revenue growth. Really, for all intents and purposes, this has been an earnings recovery that has been really based on cost cutting. Right now, we're starting to see revenue growth. Pricing will come back, we think, through the next few quarters. But the key thing is that corporate America has done a great job managing their companies in a very defensive manner, garnering cash. We know that cash flow builds earnings growth builds operating performance, and that's the part of the cycle that we're in.
Are we going to see that from Intel? Is it going to hit it out of the park like Alcoa did?
Well, we think Intel and technology companies in particular are very well positioned with respect to growth going forward. And with all of this malaise, let's call it, in Europe, we think more and more companies are going to actually come back and invest within U.S. companies.
Okay, so you also wrote yesterday that while it's difficult to describe the current mood for U.S. investors, it's easy to see what they're doing, nothing.
Right.
Does that change with the big rally today?
I think it's going to change more and more as stocks go up, because investors are not going to be able to watch it much longer. If you remember last year in the second quarter when earnings came out in July, we had a lot of investors that were very negative again, especially on consumer discretionary. We had a classic short squeeze within that sector, and that really catapulted the market. Remember, the majority of the upside happened between March and May, Lori, and then we had a little bit of a slow performance up until second quarter earnings. And people were negative just like they are this time around with respect to earnings and really got squeezed to the upside. So investors can't let the market get too far ahead of them right here.
You're also on the record saying traditional sentiment measures are sending mixed signals. So how so? And then what measures should we be looking at for market indicators?
Well, we always think the best measures in terms of sentiment is actually talk to your clients. Right?
So what are they telling you?
Well, the clients are telling us they're still nervous. Nobody really wants to commit. And I think that's a whole function of what's happening in Wall Street lately with respect to optics and the issues in terms of what we've been dealing with. But if you take a look at traditional measures like put-to-call ratio, short positions, they peaked on a near-term basis, especially relative to where they were last March of 09. But longer-term measures like TED spreads peaked a few weeks ago. So there's lots of mixed pictures. I think you really need to talk to the actual investor themselves to get a feel for what sentiment is.
Yeah, you are sticking by your S&P 500 year-end target. I believe it is 1,300.
Right.
So we're around 1,100 today. How are we going to make up those 200 points in 6 months?
Well, guess what? Part of what we wrote about yesterday is that coming out of these types of malaises, typically and historically, you've seen the market really catch fire. This could happen very, very quickly. We're very comfortable with our 1,300 target. In fact, we think it's rather conservative given where we think valuation and growth rates are. So 1,300 we're very comfortable with. Incidentally, our target for 2011 is 1,350. So we think next year is going to be the year when things really starting to flatten out with respect to stock prices. We are of the opinion that stock prices lead earnings, which lead the economy. I think the economy actually could be better than most people think next year, but earnings are beginning to slow down a little bit.
So speaking of the economy, usual suspects, high unemployment, crummy real estate market, small business tied up with credit issues as well. I mean, why aren't those such a concern to you, or at least from this conversation? You seem very bullish.
Well, let's take those in order. With respect to credit is a lot more available now than it was, let's say, in March of 09. We're talking about major turning points in the market. With respect to what's going on in the economic analysis, Lori, I've always thought is about trajectories, not ticks. We've seen so many analysts come out and be very bearish on individual monthly or weekly ticks in the economy. The longer-term trajectory of the U.S. economy is improving. Period. Look at the analysis. Look at all the charts. And then lastly, in terms of unemployment, remember, is a lagging indicator. The actual unemployment rate is a lagging indicator. If you look at the leading parts of employment, like personal income and also weekly jobless claims, we had a positive print last week. And what did the market do? The market rallied on that weekly jobless claim. So look at the weekly and the leading indicator part of employment. That continues to improve from a longer-term perspective.
Okay, so let's put some new cash to work. I noticed you're overweight consumer discretionary. We had the strong chain store sales report last week. You're really buying into the consumer holding up, huh?
You know, we are. I think the consumer discretionary sector has been one of those most under-owned sectors the last 10 years. Everyone's been betting against the consumer, especially the last 5 years. And really, we've been waiting for the consumer in this country to peter out since the 1980s. And they haven't done that yet. So we still think the consumer discretionary sector actually is affording great value on affordable earnings, especially considering that we think a lot of companies in the consumer discretionary space, especially the retailers, Lori, are modeling for the L-shaped recovery in the economy, not the V. As a result, we think their earnings are too understated.
Great stuff. Brian Belski, thank you so much for joining us today. Brian is the Chief Investment Strategist at Oppenheimer Co.